Welcome back. The United Nations Conference on Trade and Development, UNCTAD, says we shouldn't be duped by signs that the world economy is returning to normal. Now, the rich world avoided a great recession. Many countries developed stimulus measures and have recovered some of their losses after the financial crisis. But UNCTAD says actually we're still in the doldrums, and current policies are not adequate to create sustainable growth and deal with inequality. Crucially, for South Africa, that is dealing with massive unemployment and inequality, it says developing countries need more space to pursue policies that uplift the poor. The UNCTAD has hailed South Africa for taking a lead in embracing trade policies that do seek to boost domestic production and explore new regional markets. Well, to discuss, we're now joined by UNCTAD economist Alex Izurieta. Great to have you with us,
Thank you.
Alex. So people are talking about this Goldilocks economy, where there's a little bit of inflation, but not too much, and you don't have the threat of deflation like you do in Europe. So maybe America's getting there. We want that. But you're saying we shouldn't actually be fooled.
Yes, that's right. I think you used the perfect analogy, because the Goldilocks was the analogy used for the United States, mostly in the 90s when everything was going very well, exactly as you described it. And the risks are that now we may be going into a kind of similar pattern of before, in which the only developed economies that are growing at a relatively fast pace are those which have engineered their work, their growth around asset prices. And therefore, these asset appreciations have the tendency to create financial risks and financial instability. A big part of the financial instability has been experienced by South Africa already throughout the last year. And the risks.
So you're talking about America pumping money into its system. Some of that money finds its way here, so it's good for the stock market, but it could create these bubbles.
Yes, and it's not by accident, because these monies that are pumped into the system are an attempt, a genuine attempt by the United States authorities to reinvigorate demand. But because wages are stagnant in the United States, and the fiscal sector in the United States, though it continued to grow at a relatively faster pace than in Europe, for example, where there were massive austerity packages, the fiscal sector in the United States hasn't grown so much. So there is no sources of demand from the public sector, neither from the households, because the households, the main income of the households is wages, and wages have been stagnating. And therefore, this pumping of money doesn't encounter aggregate demand in the United States and move somewhere else. And it's the same with the new movements in the European Union, and it's the same in the UK.
Okay, so we're not actually in a great situation. Let's move to South Africa, because it's interesting. You're talking about developing nations basically taking the power back. And we did end investment contracts with a lot of countries, and we were criticized for that. South Africa was heavily criticized, but I saw Joseph Stiglitz came out and said, good for you, because it really ties your hands if you want to implement more BE, for example. And I see you're saying the same thing.
Well, in reality, not exactly. Well, we are saying similar things than Joe Stiglitz was saying, but from a different perspective, in the sense that our concern emanates from developing countries. We are an organization that works for all nations, but with a primary effort trying to help developing countries. And from that perspective, what we see is that because things are not going so well in the developed world, then the situation is more challenging for developing countries, because there is much more competition from main corporations and financial institutions in the developed world. They're trying to squeeze opportunities of others in the developing world. There is much more competition for cost reduction, for example. There is much more competition for concessions in extractive industries. We were talking about extractive industries in the program before. There is much more competition in tax privileges. And then therefore, developing countries like South Africa have to be very much aware that whatever they negotiate, they should negotiate with the long-term view of not losing sovereignty and not losing what we call policy space.
Well, let's talk about that, because we have a perfect example. So AngloGold are categorically saying, as you heard, that it's not disinvesting, it doesn't want to bail, it's just separating out its assets. But the fact is, miners and other big companies can punish governments who try and take a strong stance and say, we want to tax more, we need you to give back more to the poor. So what do you do? Because we've seen the JSE plunge in the past when we talk about BEE ratio.
That's right. I think policymakers should be aware that it is a competitive game. And in a competitive game, you should really put your conditions very clearly forward. There are many countries smaller than South Africa with less relative importance in the world economy. Countries like, for example, Ecuador, that we talk about in our report, smaller countries in Africa, smaller countries in East Asia, who have managed to impose conditions. And in particular, in the case of extractive industries, the corporations that live out of extractive industries, they cannot move somewhere else because they have to operate where the resources are. So you have a great leverage there, and policymakers should be aware that raising conditions that are favorable for a country like South Africa are going to succeed if they are persistent enough and if they are aware that it is a competitive game.
So you be strong, but you be competitive as well. A complaint here is policy uncertainty. But so maybe you make clear rules.
Exactly, that's exactly the point. You make clear rules. The competition should be transparent, should be clear. Everybody, the investors and the country, should have clear long-term prospects and strategies and clarity of the rules of the game. But in this competition, the worst that a developing country can do is to compete by lowering the cost, because by lowering the cost you are weakening the sources of stable growth for your own country for the long term. Because minerals are not going to be there forever. The case of the gold mines, for example, as you were reporting previously, you see the gold is deeper and deeper. There is going to be a certain moment in which it is not going to be
so make hay
profitable.
while the sun shines.
Exactly. While you have this resource, you have to make sure that you are feeding the needs of your population in human development, infrastructure development, and you have to put the conditions for that. These resources are gone forever, and the country has the right to put conditions that are favorable for the long-term development of a country.
All right. Well, thank you for explaining this report. And it is good news, I think, for South African policymakers that are following some of the paths that you've spoken about. That was UNCTAD economist Alex Izurieta.